Hey traders, welcome to Charts and Coffee. Hope everyone is doing well this Tuesday morning. We're taking a look at the S&P as we kick off the morning. And look, back and forth we go. This current issue of top tier outlook, as we wind down the month of April. I just kind of jumped out ahead of the narrative that often happens this time of year at the early part of summer, and that is, what about May, Rag? Because there's a rhyming thing that happens, right? Sell in May and go away. Who's heard of that before? I don't know if it hurts my heart or my brain more that this still gets repeated, but I'm going to give you all, because this really is at this point a public service announcement. Let me give you all a little insight into sell in May and go away. And rather than just rely on the fact that it rhymes, so clearly it must be true. Let's go ahead and take a look at the data. Shall we? All right. So this is a seasonal look at the last 10 years of the S&P via the SPY. All right. So now that we have this, there's a couple things that a good seasonal program is going to do. It's going to detrend it. So what happens is, if you were to step back over 70 years of seasonals, and you look to say a logarithmic chart, or you look at a seasonal, it's just going to move higher, right? Because the overall markets have moved higher over the last, go back any 10, 15-year block, we just continue to move higher. So we don't want to look at it through the perspective of the overall trend that's existed in the markets. By the way, the markets are designed to climb. What happens when we rebalance? What happens when there's a reconstitution? We remove underperforming names and replace them with performing names, right? This is the way of the composition of these, the Dow, the Nas, the S&P. All right, that being said, what we actually want to see when we're looking at seasonals is a cyclical behavior that we could see over the course of the year. So this is the SPY. This is the last 10 years. Now, how far back we go does matter, because if I look at a 5-year seasonal, what happens if I look back at 2024 to 2023 to 2022 to 2021, right? Two of the most severe sell-offs in history happened in Q1 2019 and Q1 2020. So those are going to be disproportionately represented when I'm only looking at 5 years, when 2 out of the last 5 had a significant sell-off in Q1. The other part of that is those 2 same years, which is 2 out of the last 5 years in this look back, right, also had 2 of the greatest accelerations in history, right, in both those same years. So let's take a look at this. Over the last 5 years, and sell in May and go away actually doesn't even originate in the US. Sell in May and go away, people will say, well, it has to do with the fact that October is so bearish. And it cracks me up when people say that. Well, then why not sell in September? All right. So it has nothing to do with that either. Again, look at the data. What in May doesn't tell us that over the past 10 years, it makes more sense to buy, right? And then make sure you're flat for the potential September or October sell-off, right? That's what the data says. And this is where, like I said, I don't know if it hurts my heart or my head more that this gets repeated. Now, sell in May and go away and come back on St. Leger's Day, right? It kind of reminds me of that saying of a jack of all trades is a master of none, but better than a master of one. You kind of need the whole story, right? You kind of need the whole thing. So a jack of all trades is a master of none. They kind of leave out the most important part, which nullifies the first part. Sell in May and go away and come back at St. Leger's Day means, what the heck's St. Leger's Day? Over in the UK, it got so darn hot in the city, these London city traders, this is going back 80 years, 100 years, they'd run off to the countryside and bet on horses over the summer, and then they'd come back, right? We have a saying sort of the same in this country, which is the money goes to the Hamptons in the summer between Memorial Day and Labor Day. So you kind of have the B team on the desk and the A teams enjoying themselves along the beach. Those things do apply. Summer vacation is kind of a human thing wherever you are on the planet. So sell in May doesn't mean I'm bearish, right? Remember, to sell could be initiating a short sell, but selling could also be just getting flat or carrying less of a position into the summer months. Last 5 years, last 10 years, all right, where is the weakness? Yes, there's a lot of volatility, right? By the way, if seasonals were all that we needed, why are we doing any analysis whatsoever? Why are we even bothering to listen to the Federal Reserve? I mean, who gives a rip about non-farm payroll, right? Who cares about growth and employment? I mean, if all we need to do is pull this up and it's going to tell us what's going to happen. Seasonals are not a crystal ball, right? I know I woke up salty this morning, clearly. Seasonals are not a crystal ball. They're a tendency of a rhythm that could play out. But what's influencing this year is going to override that. It's going to eclipse that. So that's something we want to keep in mind when we're looking at, these different things that tend to be repeated and, whether they really are true or not. So the last 15 years, you might say, Rog, there might be a little bit of sell in May, but do you really want to go away? Do you really want to get your face ripped off in June to July only to see it drop? So again, remember, these are just tendencies. And it is in fact not true. Okay, so hopefully people will stop saying that because it simply doesn't pan out in the data, does it? Does it? All right, so what are we dealing with right now? Why is the market weak? And why does sell in May get some traction? Well, right now we're dealing with an environment where the Fed fund futures, which last October, November, even the bonds last October, November, were pricing in rate cuts by the time we get to about this part of the year. March to May, we were getting ready for the first of potentially 3, if not 4 quarter point rate cuts by the end of the year. December 18 is the last meeting. We've had none. So this is the goose egg reaction. We are not getting the accommodation. We're not getting the lower rates of the Federal Reserve on the timeline that we expected in Q3, Q4 of last year. So all those things that we were doing, dropping the yields on bonds, meaning the ZB, ZN were moving higher, seeing the equity markets rally, they're now a little disappointed. This is what disappointment looks like. This is what disappointment looks like. Wait a minute, the Fed's not going to cut in May or June or July. We have to wait till September. They take August off. Yeah, we might have to. And so that's where the trend starts to say, wait a minute, this is not what we thought it was. We were buying the rumor. We were buying the expectation, right? And now we're selling the news, which is a delay of the rate cuts. So it makes sense that yields are starting to go back up. And that the ZB is moving back down. Same thing with the 10-year. It makes sense that the equity markets are now, after a significant rally, they're starting to chop. Is this a downtrend? It might start to organize into one. So this is about as bearish as I've been in the S&P, in the NASDAQ since likely, I haven't been in any prolonged way bearish the equity markets in probably over a year and a half. But this is the most bearish a look that, say, the NASDAQ has given. I'll tell you right now, since the end of 2022, right? We had a little brief time at the middle of 2023. This is the most bearish we've been. So, by the way, when you take a look at the overall trajectory of the NASDAQ over the past 2 years, clearly this has been a very bullish market. So all those naysayers, all those folks saying this is the beginning of the end, we're still waiting, right? So not so much the case, but this is just in perspective, how little time has the NASDAQ, has the S&P spent in what we would define as a downtrend. And I'm using my definition, right? I'm using my multi-structure at the bottom of the chart. I mean, how often have we been in a near term, right, downtrend? And notice it doesn't stay that way for very long. It transitions in the chop and then starts moving higher. If that's what we typically do, not that we have to do that this time, and I guess I could get rid of some of these old lines here. Not that we have to do it this time. We don't, right? Nothing has to do anything. But if someone were to say, hey, this is what usually happens, right? This is what usually happens. Well, then, yeah, I'm going to at least pay attention to the fact that there is a typical response, which is a very short-term downtrend that then transitions back into chop. And that's a precursor to an overall move higher. And by the way, just because the Federal Reserve may not cut 2 and 3 times this year, doesn't mean we may not see cuts into early next year. We'll see what gets discounted. But at the moment, we're factoring in maybe one cut this year. That is a massive disappointment from where we were, say, in October of last year, thinking, oh, we could get 3 cuts and they're going to start in March or May. Not the case, right? So obviously, indices have got to go, wow, it's not what we wanted. We wanted cheap money already. We wanted lower borrowing costs already, and we're not getting them, right? So disappointment is a thing. All right. So that is hopefully, I don't know, killing this ridiculous sell in May and go away thing. If I ever heard that again, that's too soon. All right. So again, data. And then overarching all that, forget the Fed for a moment and whatever they're going to do with rates, if nothing at all. We have to be open to that too. But by the way, if what we see right now is equities, is the equity markets, S&P, NASDAQ, Dow, responding to what we know, which is if you look at Fed swaps, those things are factoring in no cut this year. If you look at the Fed fund futures, and those are two very different measurements. If you look at Fed fund futures, they're measuring in one cut. So basically in the last couple of weeks throughout April, right? Throughout April, what have we basically accepted as a potential reality? That we're going to get 2 less quarter point rate cuts. And that's all we got? That's not bad, right? So expecting 3/4 of a point less in the Fed funds rate by December 18. Now we're expecting maybe 1 quarter point cut. And that's all we sold off. If you really think about what the market had to digest, had to accept as the new reality, that ain't bad. That ain't bad. So, I just don't see the reason to start sounding the death knell on the markets, on the S&P, on the NASDAQ, on stocks. Just don't see the reason for it until we start making a more significant move to the downside. April was a tough month, though. I mean, let me say that. So let's see what else we have here. So let's go take a look at the NAS. Same thing. NAS is a little bit further along a potential downtrend. But again, how long have the downtrends been lasting when they do organize? Not very long. So I would not, if I'm going to short, like for example, I'm in a Boeing short right now. We've got long puts in Boeing as of yesterday. And I'd like to see a lot more weakness out of this thing. But this is a downtrend. This is an individual stock that has not given a rip about the overall strength in the, say, PPA, ITA, the Dow. So I'm just trying to take advantage of a sell the rip here. Are there places that are still kind of weak? Yeah, there are. There are some places that we can look for further downside. Anything below the 200. There's a lot of things like that. Right. Magnificents haven't been so magnificent. Question on Nvidia. What do we have on Nvidia? So the thing to remember with Nvidia is we've got earnings on what, the 22nd? And what's Nvidia doing right now? Well, if you step back and look at Nvidia, it was in a trend, obviously. Now, please remember weightings, gang. We like to step back every now and then and say, well, this stock tells us where everything else is going to go. This stock is heavily weighted in the XLK. After Apple and after Microsoft comes Nvidia. XLK is really a unique sector because it's heavily weighted in the NAS, S&P, and the Dow. So it is unique, right? You can't say the same thing about consumer discretionary. Can't say the same thing about communication. So Nvidia is going to have, like Apple and like Microsoft, a potentially disproportionate effect on the 3 indices. That said, it's been bouncing off the VWAP beautifully. This is the VWAP anchored to the first trading day of the year. It's still well above the 200, which is right about 600. It is acting like it wants to turn into a downtrend. This is true. I would not be bullish after moves like this anyway. So where am I not going to be bullish? So this is where timing matters, right? Timing is trading, gang. I mean, as much as we want to somehow find ways to eliminate timing from trading, getting a good fill does help for making a better risk-reward ratio in a trade. So if I wanted to buy, for example, if I wanted to buy Nvidia, I'd be much better off focusing on green candles maybe yellow candles in the gray. That's the support of the daily price movement range. Once the candles go red, like they did right here, the gold is what I'm focused on. The gold is resistance, right? So when the candles go red, there's no long calls, it's long puts. And it's not about the gray zone, it's about the gold zone. So it's just support and resistance. That's it. So now, after moving higher and in that gold zone, yeah, the only thing I could do is look for weakness. Does everyone see that? I mean, this is just trusting your gauges. I have a downtrend. I have for 4 sessions now. Mostly red candles. That's bearish. The red candles got into the gold zone. Gold is resistance. I mean, obviously, the top end of this range is resistance. The bottom end of this range is support. So whether that be, today's Tuesday, so whether that be Friday's candle or whether that be Monday's candle, those are both long put days. Those are both days where I would expect movement lower off that gold resistance zone. So, and that's what I would look for follow through. I won't even consider being a buyer right now because we have a downtrend. But let's say, for example, we were neutral, then the gray zone becomes interesting. But since we have a downtrend, I'm not going to do that. This is where this zone is most relevant because of the downtrend. Okay. Now, does this mean I expect that Nvidia just to collapse? No, I just expect that resistance is going to hold. What does bearish mean? Let's think about this for a moment. Does bearish mean I'm just expecting a crash, that we're no longer going to buy and it's just going to go to lower lows and just complete free fall? No, bearish simply means that when price reaches resistance, I expect resistance to hold. And bullish simply means when we get down to support, I expect, so if I'm bearish, resistance will hold. If I'm bullish, I expect support to hold. That's all that it is, right? That's it. Now, if support is holding, we could say the logic would be then, yes, if support stair steps higher, then we could see an overall movement higher of higher highs and higher lows, and all those things come first. But let's just minimize what bullish and bearish is. Bullish expects floors to hold. Bearish expects ceilings to hold. That's it. That's it. So I hope that makes sense with Nvidia, what we're looking at there. All right. What about gold? So does gold have a trend? And what is it that we want to do with gold? Yes, gold has been very strong. I want to continue to look for long positions in gold. This is the first time in a long time that we've had a slightly prolonged, not since March, as you can see. I guess it's not a long time, but in quite a bit, we're getting into more of a neutral environment. Does that neglect or negate all this green? No, it just tells me that gold just isn't moving with the same swagger that it once was. So what do I do in that area? I would like to buy. I would still be a buyer. I would like to buy, but I've got to wait for the gray zone. Ultimately, there is a Darvis right there as well at around 23.15. There is a Darvis in that area as well. So I'd keep an eye on that. Am I going to buy gold? I sure don't want to short it. That's for sure. And then, by the way, if gold is moving well, keep an eye on GDX. GDX and RTX were both on our radar Friday. I'm going to continue to be on our radar. In fact, we tried to get into them, didn't get the price we wanted, but keep GDX on the radar as well. Keep that one on the radar as well. All right. Oh, and while I'm talking about metals, let me just mention copper's been pretty strong too. As long as we're talking about gold, copper's been holding pretty nicely. Take a peek. And that does open the door to, there we go, XME. Keep an eye on XME. So there are places that are in trends. They're just not the places that were in trends in Q1. SMH, XLC, the NASDAQ, the S&P going to new highs. Now what do we have? Sideways indices, if not arguably freshly bearish. We have gold strength. We have generally crude oil strength. We have copper strength. We have strength in gold miners, in energy, and metals and mining. So it's just a different group that's moving higher in this current environment in Q2. All right, gang. As always, thank you so much for being here for Charts and Coffee. I'll see you tomorrow, same time, same station. Be good to each other.